I'm going to the city and I'm gonna do a city show. And I know all my fans wanna learn how to make some dough. I've been cruising up and down for trades each and every night. And with my iPhone reclining, I know we're gonna get it just right. I'll get inside your mind, we'll have a real good time. We're gonna trade today, we gotta trade today. Go askSlim.
Hi, I'm Steve Miller. Call me Slim. And this is the askSlim Market Week. It's a look back at what happened in the financial markets in the past week, and a look forward at what might happen in coming weeks, and hopefully lots of great ideas and opportunities for you throughout this show. Well, the stock market investors got caught in a buzzsaw last week as big selling hit the growth sector of the market, leaving tech stocks splintered. Investors focused on the soaring oil market, and with each surge to the upside in oil, money flowed into energy and material stocks, seemingly financed with FANG stocks. Also feeding the bears, interest rates continued to jump, that is, until Thursday when safety bids started to come in, and that also seemed to be financed and hurting the tech sector. The holiday shortened week started sharply lower on Tuesday as Goldman Sachs came out with their earnings and the stock dropped very seriously, 8%. That's a big drop for Goldman Sachs. And then oil surged over $85. Pre-opening, the stock indexes, ES was down 50 points, and the NQs, that's the NASDAQ, were down 270. What a big opening to the downside, but it got worse, as the S&P 500 was down some 90 points at its lows. Buyers found reason to push the market up later in the week, but sellers were waiting. We saw that Wednesday as earnings came out for Morgan Stanley, Bank of America, and Procter & Gamble, and the S&P 500 opened early, up about 30 points, but then quickly reversed and fell to minus 50 as those financial stocks reversed to the downside. Thursday, very similar action. News came out of China that they were cutting rates, of course, because they have big problems with their economy slowing down and their real estate sector crumbling. And there were buyers in very oversold Chinese ADRs here. That helped the U.S. market, and bargain hunting came in a lot of stocks. But a 70-point gain in the S&P 500 was erased as liquidation persists in the market. With 45 minutes to go, after being up 70 points, the S&Ps moved to the negative side and then continued to plunge in a panic with the S&P 500 down 55 points at its low point, and that was down 125 points from its peak of the day. Kind of feeding that negative news was some old news that came out that seems to be hitting the tapes, as a very, very well-known fund manager, Jeremy Grantham, comes out and he says that a crash is coming in the market of some 45 to 50%. Then after the close, Netflix earnings came out and they were really a disappointment. Sales missed and subgrowth, well, really slowing in there, and they're really warning about that getting worse in the coming quarter. And Netflix opened down about 20% and fell to minus about 25%. And that is really incredibly weak as Roku and Disney follow on the downside also. Friday here, I'm doing this report right around midday. That big decline in Netflix had the market moving sharply to the downside, and there was panicky selling again as we saw the S&P 500 move down about 60 points, the NASDAQ down about 300, but then the market stabilized and bids started to come in and we got a reversal again as the market moved to the plus side in a small way, and we can expect this huge volatility to continue. I mean, really huge, with the trend, of course, to the downside. I've shown tons of stuff about market valuation being at excesses. That's kind of an understatement when I use the word excessive. With the S&P 500 having corrected now about 9% from its peak and the NASDAQ about 14%, that issue is not cured. I'm going to give you one more example here. And it's really about the way the Fed and the government, with all of their stimulus, has set up investors to be complacent and get crushed. It's exactly what they did in the dot-com bubble, and the market, of course, losing more than half its value, with the NASDAQ down 80% all the way to the bottom of that dot-com bubble in 2002, and then the same thing for the mortgage bubble. Where the market got absolutely crushed. So the Fed sets this all up, huge government spending, great misallocations of funds, and really sucking in the investors to believe in these ridiculously priced things. Well, we're going to take a look at a couple shots here that I think are important to look at. First one we're going to look at is this chart right over here, which looks at the percentage of S&P members with a price-to-sales ratio over 10. And this is as of December 1st. So it's pretty much corrected some since that period for sure. But when you look here, you can see way back over here at the dot-com bubble, there was about close to 7% of all of the S&P members with a price-to-sales ratio over 10. You can see in here when the peak came in 2007, it was nowhere near there. Look at this everything bubble, which was set up by, of course, Powell and Yellen and Bernanke and Greenspan, and all of them going back since the activist Fed took over. They're so afraid to let the economy actually self-correct and the market self-correct that this is what they did, and they sucked everybody in. You had about 15% of all of the S&P members with a price-to-sales ratio over 10. That is absolutely incredible. We have, of course, seen a lot of that correct, but we're talking about the S&P members here, remember. We're not really talking about the NASDAQ, and the NASDAQ has absolutely gotten hammered when you look at that. So that's a great look at the way the government has set up investors in here. And I want to thank my buddy and member, Mike Wells, for pointing this out on Twitter. And this was the source of this is Schwab and Bloomberg and Liz Ann Saunders, who had put this up also. So thanks, Mike, for sharing that with me. Let's take a look at one more slide in here that I think is really important to look at. And this is the one with ARK Innovation ETF. Of course, Cathie Wood was really the queen, known as the disruptor, known as the person who really had it all figured out, with her holdings being the ones that were going to go up for years and years. Her ARK, and she's the CIO of ARK Invest, and her ARK fund, ARKK is the symbol, made a high of 159.70 and has since plunged 60% to the downside in here. And our analysis shows you the cycle analysis, which is really nice and consistent, and the lows are due right over here. We look out in March, and remember, we're expecting a temporary low in the stock market in March. There's the target zone right down under there, under 70, sometime in late February to early March, where we think that point it'll be down over 65%. And these are their top 10 holdings: Tesla, Zoom, TDOC, Roku, Coin, EXAS, U, Spot, Twilio, Square. Those are the top 10 holdings. And you can see Tesla's one of the best. It's only down about 25% off of its peak. Look at Zoom. It's down about 60%. TDOC, well, down like 75%. You get the idea in here. These are the ones that were supposed to be the disruptors, the ones that were going to change the world. And of course, investors got sucked in, not only into these stocks, but into the ARK investment, and it disrupted the disruptor is what happened in there, and there's still more trouble to go. So that's a look at Cathie Wood and the sad situation around the ARK Innovation Fund, which has really struggled in there. When you look at that and you look at the previous slide in there, Ned Davis Research reports that 36% of the NASDAQ stocks are down 50% or more from 52-week highs. That is incredible with only the NASDAQ having fallen 14% at its worst level, well, maybe the ARK Innovation Fund is more representative of that. Now, after this week's collapse, I'm sure it's down over 40% of the stocks in the NASDAQ are down now for more than 50% from their 52-week highs. It's, you know, I'll show you just as we get to the later part of the show, the extreme oversold condition in the markets. Our indicators were calling for bounces. And of course, we're getting some bounce today in the market off of being down $60, but certainly not able to hold rallies very well. And some of these bounces are going to look quite enticing. I'm sure of that. But the great valuation reset is here. And while the bounces will come, it's going to get a lot worse. You've heard us warning in this segment for weeks and weeks and weeks about raising cash. If you get some bounces, it's still time. For the week right now, the S&P 500 down about 4%, the NASDAQ about 5% or a little bit more, and the Russell, the worst of them, down about 6%. Dow is filled with some of those recovery stocks and energy stocks and stuff like that. The best performer for the week down about 3%. The bond market, well, it went up in a safety bid, and you know that's if the stock market collapses, well, they think that will make the Fed hold off. So we saw about a 3/4 point rally for the week in the 30s, and the TNX about unchanged on the week or down a basis point, not that big of a change. And we expected a rebound here in futures, but we believe they're a sell, the Treasury futures. Gold market got a rebound on the week. It was driven by silver. Now, gold up $16, $17 in the week, but the silver was the huge driver, up about $1.40. We have raised our projections on there, though we still don't think it's a big breakout, and we still think it's going to be the second half of the year that these things are going to do much better. So $1.40 up in the week, and that's even with a 30-cent decline here on Friday. The market in the dollar up about 0.5% as that safety bid comes into the dollar, and also in Europe, Christine Lagarde says that well, they're not anxious to raise rates yet, so they're going to be well behind the U.S. And with that, it brought a little bid here in the dollar, but we don't think the dollar is going anywhere really on the upside either. And then oil for the week, make that 6 weeks in a row, up maybe about 70 cents on the week right now, but that's $24 from its trough 8 weeks ago. To the peak of this week, $24 gain. We think a correction is starting now in the energy market that will last a few weeks, but higher prices will likely come after that. Coming up, we're going to have a preview of the stock sectors. Arvi's been doing a great piece here every other week where he shows an example of swing trade setups. And I think that you're going to find this absolutely fascinating. There's 12 different stocks that he does in this video for members, but he's going to show you one of those to give you a good idea. I'm going to do a review on the plunging Bitcoin market, and I'm also going to take a 1 to 3 month view on the stock market, show you some of our proprietary indicators. So that's it for the opening. I want to remind you, please go to askSlim.com and explore our website there. There is so much to see. If you're new, become a free member or take advantage of the special I'm going to show you in a little while. On YouTube, do subscribe to our channel and give us a thumbs up. Let us know that you really like what we bring to you. Click the notification bell, and that will then let you know when we put videos up, which we do several times a week. On Twitter, follow us at askSlim, and for questions on our membership and any other thing on our huge offerings of education and analysis, please write Matt at askSlim.com. All right. Here is a preview of our member video brought to you by Arvi. He's going to look at short-term swing trade planning. He's got 9 shorts and 3 longs in this video for our level 2, 3, and 4 members. And we're going to share an example of that with you right now, where we look at multiple time frame analysis on Target, TGT. So you're going to find this absolutely great.
So this is Target, and just an FYI, we did do a trade idea here in Target this morning. What we're looking at here in Target is, if I zoom out on this chart, we have this dominant weekly cycle here, which is broken up into minor thirds. And I want to take a couple of minutes to walk through these minor thirds, because I think it is very important to really see these minor money flow patterns and how the dominant is interacting with the minor. So if you look at this, you can see we had two cycles pushing up with the minor rising as well as the dominant. We got the nice rally. Here we had a very minor pullback into that first minor low, had the rally off that minor low, sold off into the next minor cycle low right there, had a very modest rally in the context of negative momentum, as you can see right there, and that formed a bear flag, and then we rolled back down on the downside to complete that dominant cycle, where we had the dominant cycle falling as well as the minor cycle falling. Moving forward, two cycles pushing up, had the rally, had the modest pullback right here into the first minor low, the rally off the minor low, the pullback right here into the next minor low, the rally that then failed and had a modest pullback here to complete that next dominant cycle. Now, note the overall shape of this dominant cycle is a swamp cycle. When you see that, you would look for new highs in the following rising phase. We did get that here, where we had two cycles pushing up. Here we had a little bit of a fake out here as we saw some selling in the broad market. We did actually look at that key weekly low, but then swiftly turned up as we formed that minor cycle low and then made a new swing high, and that just really told us that we were clearly still in that rising phase on the dominant. After that, we really kept rallying, had a barely even visible pullback right here into the next minor low, had the rally off that minor low, and then had a sharper sell right there to complete that dominant cycle. So this is how the dominant cycle and minor cycles are really interacting with one another. If we look forward, two cycles pushing up, had the sell-off that broke the key weekly low into that minor low, had the modest rally, and are now looking for this little bit of a rally that we're in right here to fail into that next minor cycle low, which is due around the middle to end of February. After that, we will look for one more rally, and then given that we would be late in this cycle, we will look for that rally to fail on the downside. So we're trying to look further out, but obviously we need to really look at this one minor cycle at a time here. And then once we get to that time period out in the late winter to early spring, we'll have a better idea about what that next downside move would really look like. If we go ahead and shift over to the daily chart, you'll see what we're looking at here in Target. So you can see the positive cycles where we had higher cycle highs and higher cycle lows throughout that whole time period in the really bullish uptrend. After that, we had a bearish cycle, and here we had actually a move to new highs and then a move to new swing lows. So this turned into a negative cycle, and what we're looking at right here is we had this minor cycle low due. So you can see the pullback we had, and we had a little bit of a rally in this rising phase. Now we're looking for this zone from 228.70 to 237 half or so to really hold this on the upside, and then we will look for this to roll back down into this next corrective period where we have the dominant cycle falling as well as the minor. That's really what we'll be watching for. We also have a negative slim ribbon. Note, when you have a negative slim ribbon, the reason I point that out is it's very key because it gives you that sense of trend. So when you have a bearish ribbon, you can see you get failures at the ribbon and then it rolls down, failures at the ribbon and then rolls down. So it's very important for us to hold this negative ribbon in order to maintain this overall bearish downside look here. On the downside, we have a short-term 50, which comes in around 208.78, and a short-term 61.8 around 202.40. And that next daily low is due right around that middle to end of February, very much lining up with the minor weekly that I just highlighted here. So that's a more detailed look at Target.
Here is my Bitcoin update. Now, I have been pretty verbal bear on crypto and on Bitcoin. Our analysis on here has been really good, and I'm going to show you our analysis right now as it's updated, as Bitcoin gets absolutely slammed here today with over a 9% drop. Bitcoin trading down to under 38,000, I believe. We'll show you this chart, and you will see that. So take a look here as we look at the Bitcoin chart. For those of you that are new to our analysis, this very busy chart actually has a ton of beautiful information in there. When you talk about cycle analysis, it's really money flows. It's really a visual way to see that. And we learn a lot from the configuration of the rhythms of the money, shown by the cycles as they form. Cycles are measured from low to low. So you see a key low right over here, and you see another one right over here, and another one right over here. And that word nesting tells you that there is a minor cycle right in there and a dominant cycle that's coming down at the same point. These yellow ovals are showing you where the periods of risk are. Over here, we were talking about a crypto crash in spring and summer last year, where we thought the first wave would bring you down 33 to 60%, and you can see it did that just perfectly. Then we had another rally and made this big double top in here, and then it came down here as expected. You can see the minor cycle right here and how that shaped up right in here, and when the two of them come down together, they come down right into here. Momentum, this is our reversal scout, which are proprietary, which is one of our proprietary studies, which I'll show you if you watch the stock market piece that I'm going to do in just a few minutes. When it turns down right over here, it really sets a condition where you expect it to decline through the end of the cycle. Now, when I look at this, something happened here, and it wasn't pretty at all, and that is something that's called a left-hand translation. You can see our note right over here pointing here. After this bottom came as it was supposed to, we should have had a stronger rally. It rallied, hit resistance right here, as you can see, and then came down and took out that cycle low. That is a really horrible thing. That cycle low breakdown says that this whole big cycle right over here, which points way out into May, is going to be in a downward trend. You could see the minor cycle right over here, and it was projecting down. The first supports were right over here around 37,500, which we talked about as our target for this move a number of times. It got down to 37,625, and then got a rebound then here as it bounced. But you can see in here this minor cycle is saying that it's likely to continue down, and it could even get down to 29,000, to that big support right over there, that big super 61.8, or this cycle low support right there, which is at around 27,500. That is possibly what will happen. Now, we'll give it a good probability between now and the end of February. Then some kind of a rebound market out over here, and then another move down and possibly hitting as low as under 18,000 way over here. I know people will look at it and say, well, that's craziness. We're still talking about 100,000 in Bitcoin. But the probabilities of that are very low. As a matter of fact, unless it gets over this level right over here, 52,000, which would change this analysis, it is likely to continue in this downward slide that you see. Here you could see momentum continues to be on the downside, which is really quite negative. I'm going to move over to the daily chart, and we put in a bunch of the supports and fib extensions in here, and this is that 37,300 approximately right there, and then way down over here to that 29,000. It could stop anywhere in there, but you can see this bigger cycle right there that points out towards the middle to the end of February, and that's really what we're looking at, middle to the end of February for the end of this particular down wave, and then an attempted rally, and then much, much lower prices. What we have in here is the slim ribbon, which right over here gives you the momentum conditions. You see right there that little red arrow. That's where the slim ribbon went negative and warned that the short-term conditions were poor. Here you could see the slim ribbon PO. This is our signal indicator for the slim ribbon, which talks about downside resumptions. Here it was talking about an upside resumption, and you could see that's what happened. Here it turned neutral when it turned blue, and when it's red, it's negative, and when it gives you these down arrows, it's warning about downside resumptions. And here you go. You can see each of those bringing large declines. That is a very valuable indicator, the slim ribbon PO. The slim ribbon is free and is available for the Thinkorswim platform by going on our website under resources. Slim ribbon PO is only available for our level 4 and 4 plus members, and you have to have a Thinkorswim account, and you can open up one of those right on our website. So that's a look at Bitcoin. The Bitcoin market, looking here on the side-by-side, has very negative conditions, as when you have the multiple time frames showing the longer time frame a negative condition in momentum, the shorter time frame a negative momentum condition. The probabilities of the largest impulses are highest on the downside. When they are all green and moving up, the highest probabilities would be on the upside. So you can learn so much about this becoming an askSlim member and really raise your probabilities of success. So that is a look at the Bitcoin market. First downside target is hit, and there's a pretty good chance that you're going to see some attempted rebounds that fail, and then the next downside targets hit also. Our projection for sometime by mid-year is for it to fall well below that 29,000 support and potentially getting below 18,000 for Bitcoin. Pretty negative scenario, I would say. All right, we're going to give you our 1 to 3 month view on the stock market, but don't go away. This special we've been running, 50% off, ends on Tuesday. Stock Index Report live stream, where we give you short-term live charts on the S&P 500, NASDAQ, and the Russell with our great reversal scout and acceleration zones and support and resistance. You'll really be able to improve your short-term trading. Stock Index Report, SIR, enhanced snapshot on the indexes. That's a report that comes out after the close every day with great information in it. Our live chart streams, multi-time frame analysis with our proprietary studies on the S&P 500 only. We put that in level 2 because there's so many index traders in there, and there's 10 other charts that you can see if you become a level 3 or 4 member. Stock ETF weekly review, our Slimulator Momentum Tracker with over 1,000 different symbols in there, and you'll be able to see for longer term holdings the important conditions. The askSlim video library, over 600 videos for you to learn so much in 9 different categories of the market, and our new workbench with a great focus list worksheet that will let you see our 84 top traded stocks, ETFs, and futures, and see our charts in a static version with all of our analysis on there. All of that, an amazing $29.50 for the first month. And you will be able to cancel at any time. You don't have to pay anything more after that. If you don't want to stay on, just go to askSlim.com, top of the main page. You'll be able to click that 50% off little green box, and you'll be able to pay $29.50 for a month. Any questions on that? Any problem with that link, signing up, or anything? Write Matt at askSlim.com. Here is the stock market 1 to 3 month view. We're going to look at the S&P 500 and the NASDAQ on the weekly charts, and we're going to take a look at some proprietary indicators that I think you will find extremely interesting. So let's switch over as we take a look at the charts. Now, I still have Bitcoin up there from the previous segment we were doing, but I'm going to switch to SPX and blow up this weekly chart for you to see. So here is SPX on the weekly chart. And there's such interesting information on here. I think you're going to find it fascinating. I just blew this out a little bit so that you can get an idea of these last 2, 3 harmonic families in there. These are the harmonic families on the bottom. It's actually made up of a dominant cycle that you see right over here, and 3 minor cycles. If you look at 1, 2, 3, 4, 5, 6, 7 straight minor cycles that's in there, each of those had higher peaks and higher bottoms. That's what makes up an uptrend. This is your 34-week moving average, which was continually moving up, as you can see. And in the corrective periods, you get a little bit of weakness and rolling over in the reversal scout. And here you could see that rolling over right now. And what has happened was, after all of these upward cycles, all of these what we call in positive configuration and right-hand translation, because each of those didn't peak until late in the minor cycle. You can see that. Here's your peak here. Here's your peak here. Here's your peak here. All of those late or on the right side of the cycles. Now you have a breakdown in this cycle, and for the first time you have a downward movement in one of these cycles. That is the first negative thing that we're looking at. Now, the next negative thing that we're looking at is, let me just get a little bit further look out here, and that is we have broken this low of this minor cycle. And what that suggests is that there is a further decline coming in here for some period of a couple of weeks, and then maybe a rebound in this minor cycle, and then another period of big risk out over here. We have been talking about that mid-January through March was big downside risk, period of risk. And here it is. As this reset is going on, this massive liquidation that really points to this continuing out into March and maybe even into April if this extends out. So we'll look for a couple of weeks to the downside, some kind of a rebound. Once we have the anchor point, we'll put in the resistances in here, and then moving down. We talked about this 44.95 number for weeks, saying that when that breaks, it suggests a major top. And that's really what's going on here. If we get below that level, 42.79, that break confirms the major top and confirms that we're in a bear market that very well may last through the first 3 quarters of this year. We have a low due here in March and then another one due out in July. So we could get this big stair-step movement to the downside. We have warned that this was coming, and here it is right now. The next couple of weeks look really risky, and then a rebound. When I look at the NASDAQ NDX, you can see in here, let me blow this out a little bit, a very, very similar situation as the minor cycle right in here. I don't have the line drawn, but it's right here. It broke down 3 weeks ago, or 5 weeks ago, and now has continued down. This has another couple of weeks to go. If it breaks below that cycle support, 14,385, it will signal a major top and a bear market that we're in. Well, right now, 14% pullback is a pretty sizable correction, but we would be looking for a best case between now and March of about 13,800, with a potential way down over here at 12,500. So the way this would form would be, a little bit of a couple weeks down in here more, an attempt at a rebound, and then big down again into March. So you see that there's synchronicity in here looking between the S&P 500 and the NASDAQ. It points to continued downside movement, and any attempted rallies, we believe, will fail. I want to bring in our proprietary indicators right in here, and this is our market monitor. I showed this before. We're looking at the S&P 500, the SPY, the QQQ, the IWM, and the DJI. And this has all of our 4 proprietary indicators in there, and we've been talking about this being red and talking about the conditions being negative. The SPY was the last one to turn negative, and now that has. See these orange readings on the SLIM OBI, that's the option bias indicator. When this turns orange, the odds of it being extreme in one direction or the other are high. That should give you short-term bounce coming up. But we believe that that bounce, which may begin sometime in the middle of next week, early next week, will fail and it will be moving down again. What will happen was these will turn yellow and tell us it's neutralized, and then the risks will again be high. If you want to get some idea about how this works, I'm just going to go over here to looking at the NASDAQ 100. And we'll take a look at how those stocks look. Let me find the NASDAQ 100 in here. There it is right there. And I'm going to bring in all of these stocks as this thing begins to load up. And you will see how all of our proprietary indicators work. It takes a little time for that to load up because we put a big demand on the server when that happens. And we can scroll on these right now. Again, we talked about the option bias indicator. We have the reversal scout, the slim ribbon, the market condition indicator, and the OBI, the option bias indicator on here. And I'm going to scroll because I want to show you the stocks that are extreme overbought or oversold right now, because we're going to look for those orange ones right there. And you can see in here all of this list of stocks. Starbucks is in there, and VeriSign, Microchip, Amazon, Texas Instruments, all of these, Synopsys, Cognizant, all of these right in here are extreme oversold and likely to bounce. So if you want to look at the stocks that have remained positive, this is really good. Let's look at the reversal scout and look for the green ones. There are still some stocks in this category that are positive. Of course, when you look at something like Pepsi, that's kind of a flight to safety type stock. The same thing for Mondelez right over here. But look at Baidu. We talked about the ADRs in China doing better, and this one is setting up for upside. So this might be a stock that you look at for the potential of upside bounces. And of course, when you look at the red ones right in here, it gives you the big list of all of the really bad stocks that have been so weak and continue to be weak. I wanted you to see that a great platform that we have there that shows all of our proprietary indicators, and I hope you found that to be extremely interesting when you looked at that. Summing it up, the stock market under severe pressure. It's got weeks and weeks and weeks of risk out there and big downside risk, but we're setting up for some potential bounces. I wouldn't be surprised to see an update in the S&P 500 next week that holds somewhere 50 to 100 points on the upside, honestly. 100 is a lot, maybe 50 to 70, and actually holds and doesn't get sold. And our market condition indicator will probably turn yellow on some of those, and that will warn us that the downside is likely to resume again. That is everything I have to show you today. I hope you found what we brought you extremely interesting. The reminder is to go to our website and explore that. If you're new, become a free member. If you're on YouTube, subscribe to the channel, give us a thumbs up, and watch our member videos in those playlists. On Twitter, follow us at askSlim. And then you can get some of the stuff that I post there on Twitter. I put a lot of interesting things up there. And for information on our membership, make sure that you you write to Matt at askSlim.com. If you're a member and you have anything regarding your membership that you have questions on, or our website, you can also write to team at askSlim.com. Thank you very much. I want you to be so incredibly careful because it is so crazy out there. And I'm always wishing you great trading.
Well, I'm going to sit